Good morning. This is Connor from 0DTE Traders, and in this video, we'll cover the week ahead, highlighting upcoming events, market structure, SPX levels, and volatility dynamics. Let's dive in. U.S. equities are starting the week with a risk-off tone. SPX set to open with a gap to the downside, 1.2%. Qs underperforming, down 1.5%. IWM down 1%, so red across the board. We have VIX moving higher off the 30 handle, up 9% in the pre-market. Treasury rates are mostly green, while the dollar is getting absolutely crushed, down 1.3%. The spread between the dollar and the U.S. 10-year continues to widen, a signal of stress in the markets. Typically, rising yields support the dollar, but that relationship appears to be breaking down. In other words, higher interest rates are no longer propping up the dollar, which raises a key concern. Rates may need to climb significantly higher to stabilize the currency, the higher for longer camp, which would not fare well for risk assets, at least in the short term. This is likely responsible for some of the weakness we're seeing here in the pre-market. On the economic calendar this week, we got flash PMIs, existing home sales, jobless claims, durable goods orders, and the final reading from the Consumer Sentiment Index, all which will garner attention. Additionally, the Fed Beige Book and a number of Fed speakers throughout the week. Earnings season kicks in a second gear with hundreds of companies set to report. Tesla and Google will be the headliners, reporting on Wednesday and Thursday, respectively. Bears remain in control with the Gamma Index, which measures dealer Gamma negative at negative 780 million notional, trading below the key transitions 5720 flip and 5620 zero Gamma. Now, we're introducing a new mechanical strategy to our playbook, the 0DTE Iron Condor, using a very simple strike selection process and a risk management process. Now, we haven't launched this quite yet, but we will when the market starts to stabilize and short volatility becomes attractive again. But if you're interested in daily Iron Condor ideas, join the team at 0DTEtraders.com. Taking a look at the SPX 15-minute chart, there are several trend lines in play, most notably this upsloping structure connecting the lows, one test, two test, potential for a third test today, so that's a test and a bounce, whereas a break would most certainly be a bearish indication. Horizontal support shows at 5220, 5200, that is technically the put wall zone. A break opens the door to 5120, which is more or less last week's low, followed by 5100. A break of this zone implies an outside week with major support and a potential downside target this week of 5,000. On the upside, we have this downsloping structure connecting some of these highs from last week, which could be forming a bit of a flag type formation for a move higher. Resistance on the upside shows at 5,300, 5,325, 5,350, a gap zone from 5,367 to 5,396, followed by 5,400 and 5,450. The 4-hour, it does look bearish. Wave 1, wave 2, wave 3, and perhaps we're still in this wave 4, meaning we could continue a bit higher before we resolve lower for the fifth wave. Obviously, this is not a guarantee, but potential retest of lows or a marginal lower low in coming weeks. Taking a look at the SPX notional gamma chart, 5200 is technically the put wall. A break below would signal further weakness, invoking sell flows, especially with sizable net negative gamma below at 5100 and 5000. This setup means it won't take much to accelerate a move lower and shift that put wall downward in coming sessions, particularly now that we're post-option expiration and new flows, put flows or call flows could enter the market in coming days. There is negative gamma above 5200, so we're just kind of trapped here with negative gamma on both sides. But we will start to see some improvement above 5,400. So really, we look at 5,400 as a potential upside target this week and 5,000 as a potential downside target. Last week, the volatility index, the VIX, struggled to break away from the 30 level as suppressive flows, primarily Vanna and Charm, provided market support, suppressing volatility, relatively speaking. Post-OpEx, these flows have now dissipated, so we're likely to see some more movement in the VIX this week and subsequently the SPX. So potential multi-day move opposed to the chop we've been seeing. VIX upper bound 35, VIX lower bound 30. So we do look for a definitive break and hold as an indication for direction. In terms of option strategies, we've been focusing on debit structure, single options, debit verticals, really taking advantage of the elevated volatility and the asymmetry. This is where you're going to have some massive gains, and our P&L curve went parabolic here over the past couple of weeks due to those single options. Now, I know they can be a little bit pricey with elevated IV, but it only takes about a 20 to 30% ROI move to enter that risk-free debit vertical. So that's a very simple adjustment to reduce risk and maintain directional exposure. In terms of butterfly spreads, they've been fairly ineffective at capturing market moves simply due to the poor liquidity and subsequently the wide bid-ask spreads. Additionally, in negative gamma, it's pretty challenging to determine where the market may pin, so you'll lose edge there as well. In terms of credit spreads, I did sell some call credit spreads last week, but there is inherent risk being short volatility, the potential for headlines and, a big move one way or the other, which we've seen several times over the past few weeks. So unless you have strong conviction at a level, we definitely recommend against credit spreads, and again, take advantage of that asymmetry and get some big winners under your belt. Anyways, that's all I have for you guys. If you're not a member, you can join the team at 0DTEtraders.com. Best of luck out there this week.